For children, December 25th is the most important day of the year. It's the day that they open gifts from Santa. But what about for adults? It's December 14th. The Federal Open Market Committee, known as the Fed, chaired by this guy, Jerome Powell, wraps up the final meeting of 2022 on the 14th. What he says literally moves the market, and today I'll answer why and what that means for the real estate market for the holidays and going into 2023. If you want my take on it, you'll have to watch until the end. Now, if you've been following my Stats Don't Lie series, I mention interest rates every single video. If you haven't, it's the tide that lifts or drops all boats. So smash that subscribe button to make sure your boat keeps afloat by watching all of my videos. One of the jobs of the Fed is to set interest rates for the US government. Now they do this via the federal funds rate. As a 500-pound gorilla in the room, economically speaking, that rate impacts all interest rates accordingly. If you notice mortgage rates go from 3 to 7% this year, it's because of the Fed. If you notice the stock market drop this year, it's because of the Fed. If you lost your girlfriend this year, it's because of the Fed. That's what I say to myself, at least. The Fed's overall role is to balance growth and stability. With high growth comes high inflation, and it's a runaway train that threatens economic stability. If you've seen the prices of, well, anything, you understand the impact of inflation. So how do they slow the train down? Let's answer that by expanding on the train analogy. Now, this train is our economy. Interest rates represent the gas pedal or the brakes. When we press that gas by lowering interest rates, the train moves faster. Momentum as inflation becomes the outcome, and with high speed, crashing is inevitable. The problem is that trains don't stop quickly, and the faster we go, the more braking is needed to slow down. At the last 4 consecutive Fed meetings, they increased the rate by 75 basis points, or 0.75%. We've only seen one 75 basis point increase the last 30 years before this. That tells you both how bad inflation is and how much braking is being applied right now. Continued braking at this speed risks crashing the economy. But if inflation doesn't get fixed soon, a deep recession is the historical outcome. So the Fed is in this catch-22 and why they were so aggressive. The Fed measures inflation by the Core Personal Consumption Expenditure Index, called Core PCE, and it's a more accurate measurement of CPI, or Consumer Price Index. The target is to balance growth and stability at 2%, while we're at 5%. We're right at an inflection point. Inflation is showing promising signs of finally starting to come down, with Mr. Powell also reflecting that in his speech last week, and highlighted here.
Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting.
The market reacted immediately from just his comments, with interest rates dropping 34 basis points or 1/3% the following day. This follows a trend of decreasing interest rates since peaking at 7.3% in October and has dropped 1% since. With interest rates having a significant impact on housing affordability, this may be the bottoming signal for real estate if the trend continues. This would be a Christmas gift for all real estate participants, from buyers waiting on the sidelines to sellers considering doing a price reduction or not. The risk, on the other hand, is that this is another fake out. It happened earlier this year. At the time, my buyers were under contract and asked me if they should lock rates in. Certainly not financial advice, but I told them to consider it this way. If you cannot buy the house because interest rates go up, locking it in will at least guarantee your house. Now, rates jumped the following day, and they closed recently to celebrate Christmas in their new home. Now, how inflation goes is how rates will go and the economy goes for 2023 and beyond. I'll go over my thoughts after these specific buyer and seller considerations. For buyers, if you're in the process of buying, the same consideration I gave to my buyers applies to you. Of course, not financial advice. Hedging downside risk is more important in this environment. If you're thinking about buying, interest rates are where they were in September, with prices continuing to trend down since. The market slows down as well during the holidays, which may offer additional leverage for properties already on the market. Now for sellers, if you're looking to sell now, price it competitive to active listings, this is your supply, and where under contract comparables are, demand, not where they're sold. In this market, your agent is the deciding factor between selling it or not. If there was ever a time to pick the right realtor, it's now. Now, my personal opinion, and this again is not financial advice, is that inflation is more sticky than people realize, both on the low end and the high end. We've had consistent 2% or less inflation measured by core PCE for the last 25 years. Only with extremely loose policy decisions by the Fed post-COVID did that change. Now, the 1970s is the last time that we've encountered inflation like we're facing today. And two truths came out of it. Truth number one, anytime inflation runs above 5%, historically interest rates had to increase past 5% to get inflation down. We're not even at 4%. And the second thing, the 1970s saw a double top of inflation over the next 5 years and took 20 years to get near the 2% inflation goal. History says that whenever this time is different, it's not. But after the 2008 mortgage crisis, the Fed enacted a policy change of bailing out the economy when it crashes called modern monetary theory. Now, the central concept is the government with their own currency can and should print more to keep the economy going. We can all be Zimbabwe billionaires overnight. Now, real estate is one of the hardest assets available, whether this plays out or not, because ultimately everyone has to live somewhere. So real estate will always have value, and the more aspects of the top 5 factors that determine home price explained in my video here, the more the price will go up when the market changes. If you're just trying to pick the bottom, you're going to get poop on your finger. So just pick the right home, enjoy living it, and focus on what's important to you. Good realtors are worth their weight in gold, and I'm worth $5 million. What do you guys think? Comment below on your thoughts and subscribe to show me you want more market update videos like this. I'll link the next market video update here. So stay tuned and happy holidays.